All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for another post-FOMC roundup. The Federal Reserve announced their latest guidance today. A few hours ago, Fed Chair Jerome Powell gave his latest press conference, taking questions from the media. We are going to talk about that, plus anything and everything else that you folks would like to talk about there in the live chat. And we're going to do it as usual, with Fed-watcher extraordinaire, money manager Axel Merk. Hey, Axel, how you doing?
Good, especially when I see you. Always good, yes.
You're very kind. All right, well, I got to be honest, just to share a little bit of how the sausage is made today. This is my third recording of the day. I got out of my last one, had about barely an hour to watch and write up my summary of said Jerome Powell presser. So we're skidding into today's live stream with like seconds to spare. But anyways, Axel, so I titled, I think I titled this video here, Too Late Powell and the Wait and See Fed Keep Interest Rates Unchanged. Is that an accurate title for this, or would you come up with something a little different?
Well, I would come up with something different. Yeah, what about talking about the latest sports scores or something else that's even more exciting than the Fed? The reason I say that is that those who have paid attention might have noticed that there's a war going on in Iran, that we have had tariffs, that we have a tax package due. And so then there's Powell. And the reason you know it is because the president talked about it, Powell talked about it, we are talking about it. But I'm not trying to just be quote unquote funny here. The Fed is less relevant right now than they had been for a long time. And it doesn't make it any easier by the fact that Powell really didn't have anything to say. And in some ways, he achieved that quite well. The one thing he said is that we don't really have a clue. He didn't use those words, but we'll talk about these dots, right? They make their projection, and he said, well, nobody really knows what's going to happen in the economy. And of course, if they think that inflation is going to be higher, then the folks put the dots a little higher about rates having to be a little bit higher. But the context is, of course, that the data are all over the place, in part because of the volatile policy on tariffs. But the one thing that's simmering through here is that things aren't looking all that great for the Fed. Inflation was revised higher for this year, next year, and the year after. And real growth has been revised lower for this year and next year. So that's called stagflation. And in that environment, the Fed is just very reluctant to lower rates, especially since by Powell's talk, he has no idea what the impact of these tariffs is going to be. And where he is correct is when he says that it's the Fed's job that this one-time bump in inflation that is due to tariffs is going to remain a one-time bump. And so all that means the Fed is just going to sit tight, while in this case, Powell is reasonably frank and saying, hey, we don't have good cards we're dealt with. We just do what we got to do here, which is kind of, we do nothing. I don't hear you. Is it on my end or is it on your end?
No, my end, sorry.
Here we go.
So I know it would be your preference for the Fed to not have even said anything today, right? You think they should pretty much just go away until there's really something material to say. But to that point that Powell said, we don't want the potential one-time price shock of tariffs to become something more sustained. Does the Fed really have any control over that?
Yes, definitely. He's sparking as a true PhD economist, which he is not. But the idea is inflation aside. I mean, when when you put up input prices, right? Somebody's got to eat it. After, by the way, the press, Thorsten Slock, he used to be the chief economist at Deutsche Bank. He is now working for Apollo, the private lender. He said somebody has to eat it. Either the companies, which means margins go down, or the consumer, which means prices go up.
Mm-hmm.
But inflation.
That is, just to be clear, that is a one-time price shock, right? New tariff comes in.
That in itself, yes. But inflation is all about psychology. It's about what you expect prices to be, right? That is why it is so paramount that there's quote unquote confidence in a central bank. If there's confidence that the central bank will do the right thing, then medium term you don't need to worry about it. Now, trouble is, the Fed doesn't have the best track record, and recently they screwed it up badly. I'm sorry for using such technical terms here, but after COVID, they really messed it up, and inflation got very high. Kevin Warsh, who we have mentioned on this program before, who is a contender for the Fed, he gave a speech a few weeks ago where he said that when confidence is reduced, you basically have to go more by the book. You have to play by rules. And there's this entire philosophical discussion whether you have discretion or more rules-based. And he says that when you've messed up, you kind of have to go more back to the rules to regain the confidence. And one way to think about tariffs is that it is a supply shock, right? You have fewer goods coming in. And that's, of course, exactly what we had during COVID. And during COVID, they lowered the rates. And so if the perception is that the moment the economy slows down, they're going to cut rates no matter what, the market may well believe, well, maybe they don't take this inflation thing all that seriously. And so when you have now inflation expectations go up, they clearly can influence that, because if they say, okay, we're going to cut rates to whatever, so that we're going to boost this economy because of the headwinds from inflation, there is a rather significant risk that not only would inflation be higher, but higher inflation expectations would be anchored in the market. At the European Central Bank, they used to, this was before Lagarde, talk about second round effects. So you want to make sure that when inflation is higher for whatever reason, that it doesn't stay higher. And they are a hawkish sounding Fed, a Federal Reserve that has rules in place whatsoever, can be very, very helpful. So yes, it matters a great deal of how they communicate. And the reason why communication is important rather than just action is because if there's confidence in the Fed, words can achieve a lot of things, right? That's also why it's very harmful when you have interference at the Fed from the executive, because if that were credible, that means Fed policy would be less effective and more would need to be done to achieve the goal. And it all comes down to this thing that the treasuries are kind of the anchor of the risk-free rate. Everything else is priced around it. And because that is so hugely significant, the confidence in the path of when they'll do what has huge implications. Now, all of that is a bit muffled by the fact that there are currently more important priorities in the world than what's happening at the Fed. But it doesn't change the fact that the reason why we're all glued to the TV, and even I am, despite saying that he should rather not say anything, is because he does have that bazooka. And what he does say and do is hugely relevant. And you're again on mute.
Maybe this is just me being slow on the get up here, but couldn't the Fed be communicating, look, we're pretty sure that the impact of tariffs is going to be a one-off, right? Unlike COVID, which was a true supply shock, right? Factories got shut down. We just can't make more of this stuff, right? Here prices are going to go up because tariffs get slapped on it. And, we think that's going to be a one-time thing. We have some other concerns about the economy. And so therefore, let's be a little more neutral. Let's be less restrictive. And if they turn out not to be a one-time thing, yes, then we'll respond. and why not have that be the communicated message versus the we're going to stay restrictive until the whole dust is settled here?
So if they had a completely different framework, that might actually work. Let's imagine, for example, they had a rules-based framework and that used just some formulas and input, and based on that would be a policy. Then everybody would know what you're just pointing out, right? Yep, we'll lower rates, and if it doesn't work out, we'll hike rates again, and maybe we'll go down and right back up. But this is going to be exactly the path. But of course, that's not the sort of Fed that we have. We have a Fed that's purely based on discretion. They do take some input from the data. They know the data is bad right now. They know inflation is higher. They know, and they know the data is bad simply because it's been so volatile, right? I mean, I'm not questioning that. And they've had other things, of course, that for the consumer price index, the folks that assemble the data, they've had cuts, right? Doge has been effective in cutting some jobs there too. So there is that, of course, as well. But by the mere fact that we've had volatile policy, it is very, very difficult to look through that. And the other thing, of course, is we aren't, in my book anyway, completely through the ripples of the great inflation. Bernanke said, and I've mentioned this to you before, is that once you've had high inflation, the process is no longer linear. And so you can't just assume the confidence. And of course, the fact that they have messed us up recently, the fact that they're petrified of a repeat of the 1970s, all of that doesn't just bode well in saying, yeah, let's run the economy a little hot and see what's going to happen. I mean, keep in mind that if you have fewer goods coming in, there are quite possibly ripple effects, right? Because you need to, in order to produce something in the US, you need those ingredients. And so if you have fewer things coming in, but then you hit the accelerator on the economy, by all means, that could be quite inflationary. Now, the argument against that is, of course, hey, we have deregulation, we're going to do the best economy ever, we're going to be on fire, and we need low interest rates to achieve it. That's, of course, a valid school of thought, but institutionally, the Fed, the FOMC, is just not set up to think about the economy in that fashion. They want to see proof of that stuff, right? They're not going to believe the political speech and saying this is all going to be great. And just kind of practically speaking, let's assume deregulation is going to boost the economy. And even if that accelerates growth, usually it doesn't happen overnight, right? So there is a lag between putting the tariffs in place, the rewiring of the economy to produce more domestically. And so it is prudent to take it a step at a time. And I mean, it's a tough job for Powell. I don't have much pity for him to be in that situation, but not doing anything is probably one of the better things to do. Of course, by the way, he's not just not doing anything. They do have their 5-year review here in parallel. Glad to talk about that because I think they could use that time more constructively. But they are in a very tough spot, and he pretty much admits that much.
Okay. A couple of things here. One, we just had a comment here from Anna Wong. I'm going to guess that this is not Anna Wong, the chief economist at Bloomberg, but obviously, Anna, if it is you, please do let us know. I pulled it up mostly for that, but she did say here the Powell's decision's political. He cut rates close to the election last year. He was actually specifically asked about that in the Q&A, and he basically said, "Hey, look." They're like, look, if you were willing to cut aggressively at the start of last year, why are you not willing to cut now under these conditions? He basically said, well, because like it was clear that we were coming down in inflation off of the 9% high we had hit, and all our forecasting showed that inflation was going to continue to go down. He was like, now that's not the case, right?
Well, but they're human beings, of course, right? I mean, remember the dot plot right after the election where they said, oh my God, inflation is going to go through the roof, right? With Trump coming in and whatnot, and economy is going to go slow down. They're human beings, right? And that's part of the problem of having a debating club. It's always late. Clearly, they don't want to be political, but they are human beings. So that's how I look at it. I think that the best way for the Fed to get out of politics is to not be non-political, which means they got to go all the way. Judy Sheldon wrote an editorial in the Wall Street Journal the other day where she said the Federal Reserve should stop paying interest on reserves. That's a political hot potato. I happen to think the Federal Reserve should get out of buying mortgage-backed securities. The job of the Fed is to conduct monetary policy. Monetary policy is about the amount of money, the amount of credit, about interest rates in the economy. It is not about allocating money to the economy. Within the economy, that's fiscal policy. But when you buy mortgage-backed securities, you're allocating money to the mortgage sector. It's a political decision. And of course, many of the things that have been introduced since the financial crisis are political in nature. And guess what? Politicians have taken notice. Now, I'm very critical of politicians interfering with the Fed, but the Fed only has itself to blame for attracting that, right? And comments like today, President Trump made some comments about it, that Powell should lower rates. That, of course, makes it more difficult for the Fed to lower rates.
Because if he does, sort of damned if he do, damned if he doesn't, right? If
well,
he
of
does,
course.
it's like, you just kowtowed to Paul.
Similarly, right, before the election, they try very hard not to do anything, but ultimately they're going to be driven by the data. So they're done no matter how they do it, but they could take many more steps to be considered not to be as political. Now, all that said, when fiscal policy is a mess, the accusations of political meddling on the Fed side are going to increase because you need somebody to blame. And it is wonderfully easy to blame the Fed, right? The Fed can be historically above all this when fiscal policy is in order. But the more of a mess fiscal policy is, the more monetary policy will be drawn into this. It's just the nature of the beast. And so we love blaming the Fed for things, and by all means, I have my share of criticisms for the Fed, but ultimately, you can only have sound monetary policy if you have sound fiscal policy.
Right. And, he was asked about fiscal policy in the Q&A, and he basically just sort of punted like he usually does, like, well, we just treat it as this fully exogenous thing. We don't really even talk about it that much. We just kind of look and see what it is, and that is what it is.
And by the way, Paul Tudor Jones, he gave a good interview on Bloomberg the other day, a few days ago, and he said, well, basically the Fed needs to have inflation for a few years to get the deficit back under control. And the way that logic works is that as a percentage of GDP, you get the deficit down if you have inflation because you devalue the value of the debt. And of course that may work in theory.
Of course, it devalues everybody's savings too, but
it creates a whole bunch of things. Yes, I was just looking at Turkey the other day. I think 46% interest rates. Lira is just going down the drain, and I think most people listening here would not appreciate 46% interest rates. And that's the central bank where there has been extensive interference with monetary policy. So there are bad side effects when it's taken seriously. I always add this thing: if it's taken seriously by the market or if it's effective, it's tradition. Trump is not the first one to make comments about monetary policy. He obviously does it with his unique style. But the question is whether the market takes it seriously. And on the fringe, it does. But at this stage, anyway, the market does not consider the interference to be too serious.
Yeah. So look, I'm trying not to rehash some of the same topics we've talked about in past meetings, and it gets hard when the Fed just doesn't do anything here. But let me ask you this, Axel. In your opinion, is the Fed too late here, or is it doing the right thing?
The reason I'm pausing is too late with hiking rates, lowering rates, or too late with being steady.
Well, I guess the too late, Trump's criticism is it's too late in lowering them, but obviously if you have a different opinion, share it.
No, it's not too late.
Let me say one thing that'll let you go. I think there's a fair amount of people out there that think that the risks to the economy right now are to the downside. That economic growth is slowing, that the consumer is increasingly struggling, that housing is starting to roll over, that employment, while unemployment's still low, it's not a super healthy market and probably cooling in Powell's word, weakening in other people's words.
Yep.
So I think there's a lot of people that are like, yeah, like why not err on the side of
Well,
cutting?
because we've gone through the 1970s. That is the answer, right? Same sort of thing. Economy was weakening and whatnot, and the Fed decided to lower rates. And guess what? It blew up in everybody's face because inflation
Right,
shot.
but
Right?
where
None
is
of
the
this.
pressure here besides a one-time tariff price shock? Where is the pressure here inflationary wise?
Well, in the just I don't know whether I can share my screen here. Let me just put up the table if I may. Am I able to share my screen? Let me just.
I think if you click the present button down there,
Yeah,
it'll come up.
let me just see whether this works. Probably not with.
All right.
image.
And while you're finding it, somebody asks me, hey, if everything's bad in the economy, why the heck are stocks inching to blow past all-time highs? Well, first off, I think we could have a big discussion about how richly valued stock market is in general. I'm not necessarily saying everything is bad in the economy. I'm just saying, and this is not just me, this is a lot of people I've interviewed recently on this program, you know, there's a lot of cracks in the economy to point to right now. So I think the questions are valid. But I would say, look, even without those cracks, we could make an argument that stocks are pretty richly valued anyways on practically every metric that's out there.
In this fancy program I have,
Here we go. Yep, I see
file.
it.
I don't know whether you can pull it up. Here we go.
There we go.
So this is from the Fed today. The red arrows are my addition, and those are negative trends. The green arrows are positive trends. And I think you count about as many green arrows as I do.
I was going to say, I don't see any green arrows.
Yes, exactly. But so the top here is the GDP forecast. The GDP forecast has gone down. That is what. And so things are weakening, right? Unemployment rate is heading higher than just forecast in March, right? This is relative to March, and so this is 100% in agreement with what you just said. Oh my God, things are weakening. The problem is the other set of arrows below. PCE, that's the inflation metric the Fed likes to look at. And inflation expectations have been moving higher, right? And so that is really the problem, that there are two elements that they need to worry about. Greenspan used to say that let's just focus on inflation. He's aware we have a fully a dual mandate, but if we can take care of inflation, the job market will take care of itself. And of course, the Federal Reserve cannot control unemployment directly. It can crush unemployment, like raise unemployment with higher rates, but the Fed cannot create jobs. And so that is really the challenge. And the reason I made the parallel to the 1970s is that there is a real risk that if you give in and say, okay, I'm going to lower rates because, hey, let's give it a try, let's boost the economy because things are slowing down, then things will look bad on the inflation side. Now, is it correct in the sense that, yep, this housing market is weakening, the consumer is weakening? That's all correct, right? That is absolutely correct. But it doesn't mean the Fed should lower rates because the Fed is in a tough spot. Now, could the Fed have a better framework? Absolutely, because the Fed, as I just pointed out, doesn't have access to data. The data are a mess. So if the Fed waits for the right data with the volatile policy we have, it's a problem. And I mentioned the executive orders of Trump. Well, that's an element in not having good data. There are many other reasons. One of them is that the Federal Reserve has taken away many of its own gauges. Example I mentioned before is during the financial crisis, the Fed started paying interest on reserves rather than having this minimum reserve regime where the Treasury desk intervened, where you would see problems in the economy more readily. Or there are many other areas where the Federal Reserve is just reading the tea leaves these days, whereas in the past there were many more data points available. And so yes, this economy is slowing down, but it doesn't mean that a prudent Fed is going to lower rates.
All right, so a couple of things. I guess let me start with data. So you and I have talked forever, Axel, about the increasingly specious nature of the official data. Everything from the BLS stats and whatnot. It came up in today's press conference, and Powell did say, yeah, the data is not where we would like it to be, right? And yeah, don't worry about that guy. We're used to having dogs in our reporting too. But I guess my question to you, Axel, is why is the data so crappy? I mean, we've got tons of government employees. How many PhDs does the Fed have working for it? Powell was even talking about doing a 10% reduction in force across the Fed. Like, with all these resources, why is the data so bad?
I'll give you a few different answers. So the quote unquote bad data we have right now is simply because of the volatile policy, right? Regardless of the quality of actually reading them. When you have tariffs of 50% one day, 10% the next day, 0 the next day, and you don't,
okay,
it's very difficult to extrapolate from that. So
that's one thing. The bullwhip effect caused by the Trump.
Exactly.
Effect.
So that's really what I think Powell is referring to. The other one is, of course, and there I 100% agree with you, is why isn't the Fed looking more at more modern set of data, real-time data? And again, to mention Kevin Warsh, I mentioned before, he gave a speech a few years ago where he said just that. We got to use the resources of the Federal Reserve to look more at real-time data. This was before the AI craze, right? That there are things available out there where you can have a more real-time impact. Now, of course, they have smart PhDs there, and they'll give you all kinds of information. So it's also the monetary policy is a bit like a huge freight ship, right? You don't change the course too quickly. They want to see 3 months of data and this and that. And indeed, Powell acknowledged as much. The last 3 months were kind of somewhat encouraging, but it is still, with everything that's going on, with all the cross currents, it is very, very difficult for them to do something. It would be much easier if they were rules-based, right? But the process they have right now is just being a debating club. And in that sense, I've asked people, they have this 5-year review happening right now, and he alluded to that, and he said, well, there are two components to it. One is the framework, and one is the communication. If I understand them correctly, they saw nothing wrong with the framework they've applied and with the framework they've had in recent years. The reason I corrected myself is that their problem was that they didn't execute the framework properly. But the framework was completely fine. And they have had absolutely minimal criticism of their approach to monetary policy. They run into the same problems over and over again, but they just keep going back to what they've always been doing. And guess what? Some people are critical of that, right? And it doesn't. If you had a clear rules-based approach, you could do more. What you're suggesting is, let's be a little bit more sensitive to the data, and if it doesn't work, we'll do a U-turn. And if you do that in a rules-based approach, you can just say, yep, that's what the formula said. And of course, yep, last month we lowered rates, this month we hike rates, and so be it. And the important thing with any of this stuff is visibility, right? There needs to be a transparency about the process and credibility that it's going to be adhered to. Whereas the only credibility we have is that the Fed has a bazooka, and we better do what they tell us is going to happen. And so, given where we are, their hands are pretty much tied.
Okay. So, last point on this, and then we'll move on and take some more user questions, and talk about gold and the precious metals, because there's been activity there, and also some questions here for you about what's happening right now geopolitically. But the tariffs, as I said, those seem to be, unless something else happens, that's going to be a one-off bump, right? Everything that I mentioned there, and we'll go back to your chart of all the red arrows, right? All of those things are trends, and trends that some of which are building steam in the wrong direction, right? Housing market weakening, more inventory coming on, price declines, stuff like that. One would think the Fed would, because I don't know how many times today Powell talked about the Fed being forward-looking. like when they asked him about why don't you cut? There's all these reasons why you should cut. And he said, yeah, if you just looked at the data, we would cut, but we got to be forward looking. Tariffs are happening. We don't know what the extent of them is going to be. And I get that, but I feel like you're trading, what seems to be likely to be a one-time event, and you're prioritizing that over a number of trends that are going to be secular.
The problem is that the Fed cannot know whether if they push the rate up, whether the economy has the capacity for that growth because of the tariffs, right? Because there have been supply chain disruptions with the tariffs. And so if you hit the accelerator, maybe we'll mostly get inflation rather than producing more goods, and we don't know whether demand is going to be there in the population. And I agree with you, right? What's going to happen, I don't know whether I agree with you, but what's going to happen, I think, is that, yes, the Fed will be, quote unquote, late in cutting rates with regard to economic growth, and it's going to be a suboptimal outcome, right? And then, of course, you have a president who's going to get furious and yell and whatnot. I think the far more important thing is probably who is going to be the next Fed chair, because we can argue here all the time, is this the right thing for Powell to do or not? Well, he got the bazooka, we don't. And so we just got to put up with what we got. And similarly, President Trump needs to put up with it. And so he has a choice, though, of who he's going to put in place next. And it's going to be super interesting to kind of monitor that process. He's probably going to make it a reality TV show like everything else that he does. But it matters at the end of the day of who it's going to be. And the core challenges, of course, that we're spending too much money, that we have a very strong incentive to debase the currency. And by the way, we're getting a weaker dollar. And we have an incentive to have more inflation. And so do we have a Fed chair, or going to have a next Fed chair, who is willing to inch inflation higher? And if we were to have that, is that person going to be able to get higher inflation while providing the illusion that they're going to look after price stability? Because if you don't provide the illusion that you're going to get prices back to being stable, this thing can get out of control.
Right. And you get the unanchored expectations.
Exactly. And so that is really the circle that needs to be squared here.
Okay. All right, where was I going to go with this?
You talked about the market being expensive in between. I never got back to that.
I had one other question that I'm sure will pop back into my brain. Folks, I'll start pulling questions from the live chat here in just a second, and I just remembered my question. So we had talked about Kevin Warsh, right, who you thought might very likely be a good contender for next Fed chair. I just interviewed Darius Dale a couple hours ago. That video is not out yet, folks. It'll be out on Sunday. But he was, of the strong opinion. Now, he's not as close to some of the people who actually, have served in the Fed as you are, Axel. But he's of the opinion that, especially after the headaches with Powell, Trump's just going to do what Trump loves to do, which is just find the biggest loyalist he can and put him in that chair. Just a guy who just says, President Trump, whatever you want me to do, you just tell me, I'll do it. What do you think is the likelihood of that happening? That Trump really tries to put in, a loyalist that he can use to control the Fed?
Never say never, right? I think the market will tell us sooner than anybody. And the market is currently not telling us that he will put in a loyalist, because we will see a difference in inflation expectations, in the dollar, in many other things. And so the market is currently telling us that it's going to be a status quo. It's going to be, flavors are going to be different, right? We'll complain about different things with different Fed chairs. Is there a possibility? Is there a risk? Yes, definitely. It's certainly a possibility. And again, like Paul Tudor Jones said, he should appoint somebody who's going to push up inflation. Those incentives are certainly there. The there are plenty of people around him, though, that will tell him that it might not be a good idea. So whether he'll listen to that, I do not know. So it's a good question to ask, but it's part of the reason, of course, why I say it's so important of who the next one is. I mean, the biggest disadvantage Kevin Walsh has is he's been in the running for so long that often it's not the person who's named first who actually gets the job at the end of the day.
Right.
So that's the biggest thing.
Right. And Walsh doesn't strike me as a pushover too.
No,
he strikes me as a guy that if he's got a principle,
but he is diplomatic. He has visited Mar-a-Lago several times, and so he does have the president's ear. As someone may recall, when he was in the running when Powell got the job in the first place, and Trump said, "Oh, he looks too young." Well, he's several years older, so he doesn't look quite as youthful anymore. So maybe fulfills that criteria. Although Kevin Walsh is known to be more of a hawk, right? And so, of course, that's a thing that probably squarely goes against him.
Yeah. Trump was, yeah.
So to be seen. But Kevin Walsh is somebody who very much believes in looking at real-time data, which would be very much more in favor of something that Trump is envisioning, right? Having a good person at the Fed is worth a lot to a president, and good does not mean agreeing with the president, but good means actually reforming the folks. Kevin Walsh is a lot about reform. He is very much about getting the politics out of the Fed, and so there would be a lot that could happen. Now, does that mean that rates are going to necessarily be lower or this or that? I don't think so. But there are still some very important reforms that could be instituted, and it could be that it's telling President Trump that he's going to do these reforms that's going to get his ear, because nobody at the Fed has done any reform whatsoever, and it is way overdue to kind of reintroduce some better practices.
So totally agree with you there. I guess what my brain is just sort of ruminating on is it is a little bit weird with the Fed chair, because the Fed chair is a governor on the executive branch, right? It's something because of its independence is supposed to act how it sees fit, and that sometimes can clash with an agenda that an administration has, and yet you have the president appointing the head of the Fed, right? And look, we've all been around long enough, Axel, to know that politicians are no angels. It's just a little strange to me to think in general that any president is really going to try to find somebody who's going to have a lot of backbone to push back against them, but particularly with Trump. And
Ronald Reagan did, right?
Yeah, sure, but that was a long time ago. But particularly now, right? Like in this second administration where Trump, rightly or wrongly, believes that, he's getting all this pushback from the judiciary system. He's not getting Congress to jump as much to the tune as he wants. He's got the scars from the lawfare that was, that's been served against him for the past 5 years. So to me, he just seems, I don't know why we would expect him to do anything other than just try to pick a guy.
I'll give you two answers. First of all, he will not hesitate a second to spin any story to the way that he would like to have it spun. Like you mentioned just a few things. I'm pretty sure if you ask President Trump those things, he would give you a different answer of why he was fantastic dealing with each one of these situations, right? So it's about communication, and that's one thing, and he'll deal with it. The other portion is, though, as I mentioned before, the market currently states the next person will not be radically different. And if there were a pushover at the Fed, long-term inflation expectations would move, right? We've had this discussion before. A lot of the audience would say, we have no idea what long-term inflation will be. Well, absolutely correct. But expectations as priced into the market are hugely relevant for global asset prices. And so you can measure, in some ways, the confidence that the market has in the Fed. And those measures have not dramatically moved. In some of the earlier interferences that Trump had, there were some tiny moves, nothing of great significance, but saying, oops, the market is taking notice because of what you're just saying. Hey, can you trust him not to suddenly really interfere? Right? It's one thing to kind of have a little rant about how bad Powell is. It's another to actually interfere. And so it's in a similar vein. If the market were to believe that some sort of pushover would follow Powell, we would see that in the market. Now, I am not saying it's not possible, but I do say that the market is currently not pricing that in.
Okay. Last question on this, then we'll move on. I heard Bessant being asked, Treasury Secretary Scott Bessant being asked about, I guess, some chatter that he may actually be tapped to go head the Fed. And he said, I don't know, but I'd love to serve out my term as the secretary if possible. You know, when Yellen left the Fed and then became Treasury, the way in which that was spun was, hey, we're going to have some really good close coordination between the Fed and Treasury because you've got the former Fed head now here. And yes, the Fed will still be independent, but they're just she's going to understand the Fed world, and it's going to make them work more closely together. I guess what I'm trying to say is, like, if Trump appoints somebody at the Fed who just is looked at as a lackey, but people are like, yeah, but if he's being directed by Bessant, and Bessant's a really smart guy, like, could the market almost interpret that positively? Like, hey, we got Scott Bessant running both Treasury and the Fed.
I think Bessant as a Fed chair is a realistic possibility. I happen to think going from Treasury to Fed is much easier than the other way around, because when you go from Fed to Treasury, you're going from a somewhat academic setting to a hostile political setting. And I had my concerns that Yellen would be up to managing kind of the Treasury Department, simply because of kind of what I've known about her executive skills, right? She used to be head of the San Francisco Fed, then become the Fed chair, and then was Treasury Secretary. And by all means, she was a lot in the background in her job as Treasury Secretary. Now, Bessant, one of my concerns when he has become Treasury Secretary is he was never a big business executive. I mean, he's a hedge fund manager, a successful one, right? But never run a large organization. And so similar concern, but apparently has found its footing. Making that transition to the Fed, I think, is not as difficult. He does understand currencies and has studied that for ages. So he does understand monetary policy in that sense. You don't need to have a PhD economist. Powell isn't one. There are former Fed chairs, not in recent times, that were business people. So it is absolutely possible that it is Bessant, yes. And in some ways, Trump may feel that might be a safer choice for him. So but I wouldn't consider that a radical departure from where we are right now.
No, and actually, my point was less that. To be honest, I'm guessing here. I don't think Bessant would want to do it. I think Bessant likes I think he feels he can get a lot more done at Treasury than he can at the Fed, which is kind of funny. Like, he might have more, single action impact on the world as the Fed, just because the whole world revolves around, Fed policy. But at Treasury, not only can he run the Treasury, but he can, lead all the trade deals. And there's just so many other things that he's getting pulled into. My sense is he feels like his legacy can make a bigger long-term impact staying at Treasury. My point was, if they kind of installed almost like a junior guy as Fed chair, so that Bessant could direct him while still running as Treasury Secretary and managing both together, could the market in some way, if they like Bessant, look at that as a good thing? Like, hey, we actually got a really smart guy running both things now.
Yeah, well, lots of theoreticals here, right? I mean, it's let's take it a step at a time. You never know what things people want to have on their bucket list, right? Keep in mind the midterm elections are coming up. If things don't go particularly well, then maybe you want to say, okay, I've done my job and now I'm going to try something else. So
nice exit strategy. There
are going to be so many considerations. I mean, going back to kind of what you alluded to earlier about kind of what does it mean for us? Why do we care? And the reason we care is because the Fed has a huge impact on the markets. If the economy goes down and they let it go down and are quote unquote late in cutting rates, well, what does it mean? I think the bigger factor is what's this tax package going to do, and is this economy actually going to accelerate, and are we going to attract the sort of long-term investments to rebuild the infrastructure in the US? And for a lot of that to happen, you need clarity, and clarity is not exactly a strong suit of Trump. Now, by all means, the tax changes that are on the way might provide some of that. Indeed, there are some positives in there, especially in the Senate version of the bill. And so we could see some of that. I think that's going to be far more impactful than whether Bessant or Wash or maybe somebody else, quote unquote, like them, if there's somebody like them, that would be the next Fed chair.
Okay. All right. Well, look, like I said, this was very much, a wait and see message from Powell. Almost every question he was asked was like, look, we're going to wait and see, and then we're going to figure out what to do. So not a ton to parse out of today's Fed action. But while I got you, Axel, because there's a lot of questions here in the live chat about it, let's move over into the precious metal space. So the bull run in precious metals has continued. Gold has reclaimed 3,400 an ounce. Platinum and silver have had price breakouts. They're getting hit a little bit right now at the end of the day today, but they're still at near very recent highs. In your opinion, what's driving this? Is this all mostly just fear trade? Is it technicals? Is it speculative capital coming into the space? What is it?
So first, just clarification, we're just under 3,400. We're at 3,369 right now, if my eyes
all right. And I was talking gold futures price.
Yeah.
You might be talking spot.
Yeah, I'm talking spot. Yes.
Okay. And actually, it looks like gold futures.
I'm not a paper gold guy. Maybe you are, but
well, I'm on Yahoo Finance, and it's what they have on the top. And just to be super clear, it tanked in the last hour of trading. They're at 33.82 right now. Yeah.
Exactly. Exactly. Yes, and the futures are also a bit below 3,400. In any case, what's driving it? So I'm not going to dismiss technicals completely. Gold attracts technicals more than other segments of the market, in part because the fundamentals are just so much more so much simpler, right? When you have more complex fundamentals, they have a big influence, whereas in gold is just this brick, right? And so it is prone to having more technical investors invest. That said, gold, because it is quote unquote a brick, it competes with the purchasing power of the currency in the long run. And so if in the long run people believe the currency is going to depreciate, it might have value to have this brick, which just is and doesn't change. The one thing, of course, that's happened, which we haven't talked much about, is that longer term rates are notoriously high. Right? Many people would have thought that 10-year rates and longer rates would have come down further. One thing I've argued with you on this program is that the plumbing of the financial system has changed due to tariffs. When you impede the flow of goods, you affect financial flows. Deficits need to be financed more domestically. And I think that has a profound impact because it increases the pressures. And we know that politicians are not going to get the message until the pressure is very high. But it means that the pressure on the Fed, for example, is going to increase. And so this discussion, although I somewhat dismiss it that we're going to get some sort of pushover, the concern is a very, very real one. And I think we do see that reflected in the price of precious metals, that the folks buying precious metals, it's kind of the one insurance we have. We pointed out to a weaker economy and the Fed's hands being tied. Well, if the economy gets weaker, and especially if companies absorb the cost of the tariffs, well, maybe the S&P isn't quite as attractive. So gold is one of the things that might do okay. If the Fed is late, they might be forced to cut rates in a more pronounced fashion. That's good for precious metals. So there are all these reasons why people might be inclined to buy precious metals. And I think they're very valid ones. And most notably, of course, the fiscal situation. There was a story out yesterday or today that the Social Security Trust Fund is going to run out in 2034, earlier than previously thought. And my answer to that, by the way, is that if I understand the law correctly, if that were to happen and Congress doesn't make other provisions, the executive can prioritize payment, which means the executive can pretty much do means testing as to who to give Social Security payments to, and the wealthy will not get as much, which is presumably also what the law would change if they were to take their job seriously to make it more sustainable. But there are lots of pressures out there. The fear factor, I never like it when the price of gold goes up because of a war or something, because that tends to be short term.
It can be taken away quickly.
Yeah. Other than if it signals a new era, and I've talked for a while now that I do think we are in a new era where the peaceful period since World War II is over, where the cost of doing business is higher. And of course, it doesn't really matter whether you're talking about geopolitics, about tariffs, even climate change, right? The cost of doing business is higher when there are more floodings, when there are more fires, when there is more disputes in the Middle East, when there is more, and of course, some people are saying if Iran is substantially weakened, we'll have a peaceful period in the Middle East. Of course, that could happen, right? But I also mentioned Turkey has interest rates of 46%. I think that's important geopolitically, right? It's just a sign that this world isn't as stable as it had been for an extended period.
Right.
And some central banks are continuing to buy gold because they also see that, well, maybe it's good to have that insurance. And by the way, just on the other side of that spectrum, I think it was Moody's that came out and said, oh, don't worry, that there's no threat here to the dollar because there's no good alternative. And that argument is just fundamentally flawed because there doesn't need to be an alternative. We can have a disintegration of global finance, and that's what we're seeing, and that increases the cost of doing business. And because we need to make all these entitlement payments and have promised citizens everything, there will be an incentive to pay for things through inflation. And in all of that, right, we can talk about Powell all we want. He'll do what Draghi does. He'll do whatever it takes because you can talk nice only for so long. And at the end of the day, you need to keep things well oiled and rolling.
Yeah. So how much of the current run that we're seeing in the precious metals, particularly gold, is due to kind of long-term concerns like you just mentioned there, versus just the war uncertainty premium right now? I guess maybe the so what question is should investors that are enjoying today's prices in the precious metals steel themselves for the potential that if hopefully peace breaks out in the Middle East or the conflict is resolved, diplomatically, that it's likely we'd see some sort of pullback in these prices?
Well, all I can tell you is that I haven't sold my gold. I have told people I sometimes have to sell some for operating purposes because we actually get paid in gold in some of the work that we do. But I haven't sold any meaningful gold. And I've told people I sell my gold when Congress gets this act together and goes to fiscal sustainability, to which I usually get the response, so you're never going to sell your gold type of thing. And so it's a timing gold investments, and mentioned earlier technical investors. If you have somebody who's great on technical investing, by all means, be my guest. I would urge people to have a process, and my process is a long-term one. If somebody is good with a short-term process, by all means, embrace it. The challenge is that the price of gold can become very volatile. And so timing these moves is extremely difficult. I see the long-term trends. I think it's helpful to consider having gold as a diversifier. And ultimately the allocation is one of risk tolerance. But beyond that, I don't know what the price of gold is going to do tomorrow.
Mm-hmm. So you're obviously a long-term holder. Rick playfully asks, so you're going to hodl gold. And that sort of is your strategy. Let me ask you this. What indicators do you think would cause you to start thinking, you know what, it's time to actually start selling some of this? And this may be 10 years in the future, 30 years in the future, but like what?
Well, when we have fiscal sustainability, when we go on a path towards fiscal sustainability that is credible, and the Doge is not it.
So never. That's what you're saying. Never.
Well, the other portion is, of course, if you need the money, right? I mean, gold tends to move from those who have money today to those who have money tomorrow. And so if I'm not getting any younger, right? If I retire one day and might need to use up my assets, I might be selling some gold. But if I generate an income, I'm pretty happy with an allocation. So I can't say what I will do in the future, but it's just. Well, I'll give you a different answer. On our website, we had a webinar, I think it was about a year ago, maybe half a year ago, where we showed different economic environments, how gold is doing. And in the environment where you're coming from a high inflation environment to a lower interest rate environment, it tends to be very favorable for gold and gold miners. And so if one wants to look like short term, or shorter term, we have somewhat been in the sweet spot. And of course, the question is always, when do you get out from that? And if we are in some very repressive, super low interest rate environment, there's a possibility that gold might not be as favorable. Can we get there? Sure. Do I expect to be there anytime soon? No. And so there might be some adjustments if we were to come to that. What I have seen is that there's substantially more interest in gold and gold mining. For those who don't know, we currently manage about 2.4 billion in that space. And so we do see a lot of what investors are thinking. But it, of course, doesn't mean that the price of gold or gold miners go up every day.
No, but so you said you're seeing more interest right now in the price of gold relative to gold miners. But that's the way the progression.
They're different. People often commingle the two, but historically, the gold investor is more of a defensive investor. The gold mining investor is historically more of a speculator. They say they're defensive, but because of the volatility in that space, they tend to be more of a speculator. So they are not, they talk to each other, but they're often a little different investor profile.
Yeah, the reason why I asked this question is gold tends to move first, and then as the gold price moves, then the speculators get interested, and then they move into the mining stocks. So we were starting to see the mining stocks finally come to life. They've had a good year so far, and we're just beginning to see silver start to go on a price breakout here. I guess sort of how early in this price reaction do you think we are? Do you think these have a lot of room to run in this current cycle? Or have we seen most of the movement they're going to have, and then they're going to cool off for a bit?
Well, the market is still not giving them the benefit of the doubt. The profit margins for the producers in the coming earnings season should be rather high. And the market is not giving them the benefit of the doubt that they can execute in the medium term. And of course, the context is that investors have been disappointed many, many times. The big miners have repaired their balance sheets, which means they have less of a leverage to the price of gold, have gotten involved in these huge projects that are difficult to execute on time and on budget. And so, and they have started to reflect the higher price a little bit more. In the junior space, they still, I don't think, have reflected the sort of pricing that we have in the spot price of gold. Maybe because the market doesn't believe the prices will be around long term. That said, one of the things that has happened is that activity in the on the corporate side has picked up significantly. Funding is more readily available. Merger activity is picking up, and so those are signs that we're not in the first inning anymore. That there was a long dry spell, and that has especially the larger mining companies have no problem raising capital right now.
Mhm.
And so we're not in that early inning, but at the same time, we don't see any wild deals happening. We don't see any craziness on that. And also, I think especially in the junior miners, the prices are still relatively depressed. Part of it is, of course, that there are very few active managers these days. ETFs don't buy junior miners, at least not the very junior, and they don't participate in fundraisings and whatnot. And so there are fewer players around. And so, yes, that space is coming somewhat to life, but I'd be very, very surprised if we were in a late inning here.
Okay. Could that be a limiter on the enthusiasm the sector sees this time around because there are less active managers to buy these stocks?
Well, you can interpret this in different ways, right? The good news is that there's value, right? As I mentioned earlier, the mining investor tends to attract the speculator, and especially on the junior end, because that can be extremely volatile. Now, of course, for the speculator, there's been more competition. Meme stocks have been competition. Digital currencies have been competition. And so many of those folks, though, are not very loyal. And if there was really something amazing happening in that space, they may well come back. But yes, the market overall is pricing an ounce of gold far more conservatively than they have in the past. And it's but one indication that I don't think we're at the end of the cycle.
Yep.
But of course, it's perfectly possible that the cycle will never go quite as crazy as it has in past cycles. That would be inconsistent with history, but it's certainly possible. The good news then is that then the downside that might come afterwards might also be more benign.
Okay. All right. Well, look, I could keep going with you, Axel, but we are here at the end of the hour. Thank you so much for doing this again. Actually, quite a substantive conversation given how little there was to talk about in terms of what the Fed actually did this time around. It'll be interesting, when we do this next time around. I don't have the next date off the top of my head. Do you know when the next FOMC meeting is?
It's usually 7 weeks. So let me just look at this here and see whether I can find it. But it is. Well, we'll look it up. We'll give it to the folks here.
So well, whenever it is, folks will do it.
It's 30th of July.
30th of July. Oh, okay. So actually, right after my birthday. Speaking of which, folks, so if you've enjoyed this, and if you've enjoyed this session, but if you enjoy these special reports that Axel and I do after each Fed meeting to kind of give you guys a real-time deconstruction of it, if you'd like this format to continue, please let us know both in the live chat or in the comment section below the video. I think so far feedback has been good, but we always want to listen to you to see if you like this stuff to continue or you'd rather see us do something else. So anyways, do that, let us know. And also, obviously, if you like this, hit the like button. That does make a difference in how this video gets picked up by YouTube. But more importantly, folks, I was just looking at my stats. I noticed that almost half, about 47.2% of the folks that watch these videos are not subscribed to this channel. So if you are watching this right now, please do me a favor, just take the 2 nanoseconds to click the subscribe button. Doesn't take any effort on your end. And the benefit of being subscribed is that when we release a new video, you'll get an alert so you won't miss new videos going forward. And obviously the benefit to the channel is the more subscribers we have, the more YouTube, more love that YouTube gives this channel. So it's a whole virtuous cycle. All right, Axel, and just wrapping up here, you had teased out on X that we were going to talk about, everything under the sun, including my dog, which is great. She's doing well, by the way, folks. But I thought I'd ask you just real quick about your fitness right now, Axel. What are you doing these days? Because when I lived near you, I knew you were a big runner. You're doing marathons.
But I sleep. I don't know whether you heard from my voice. My entire family was sick, and I was holding up. And then finally, over the weekend, it got me a little bit, but I didn't crash and burn, and so but I've been sleeping a lot in recent days, going to bed early. Otherwise, I do ranch work. That's the main thing I do. I still go running, not as much as I used to, but ranch work. And one of the funny things is I'm wearing one of these whoops, and it's just not equipped for any of the exercises that I do, or most of them that I do. It's just can't figure out what the hell did you do today? And it says, well, ranch work, of course, and so it's not meant for that.
That's so funny. Is it like thinking you're having a heart attack 4 times a day or something like that?
Yeah, no, it's struggling. It's struggling with most of these things. Running, it recognizes that's a more traditional thing, right?
Yeah.
But yes, I am doing physical work, cutting trees, and driving a tractor, and changing implements.
That's functional fitness. That's why we do it, right? We do it so we can do real things like that.
Exactly. When I see you with your rucksack there, I said, well, get rid of that stuff, and I need a hand with something, right?
Yeah. Well, it's funny that so I'm going to this guy, a strength coach. I went initially for rehab with my knees, and I'm going to tell you a quick little story that's going to, I think, relate to you, Axel. But I went there initially for rehab, and now I'm just doing it because it's so good for the body. But it's all really functional stuff, farmer carry. I mean, just heavy things like 90-pound. Sack full of sand, you just got to, walk for 100 yards or whatever. I mean, it's teaching your body to do like real things that you might need to do on a ranch. But anyways, one of the things
get a ranch and do the real thing.
Well, maybe I should come down and visit you. You can put me to work. Yeah. But what's interesting is I was initially like going into rehab for my knees. I'm doing a lot of study, and one of the things that's very beneficial is getting your knees over your toes in a movement, which most people don't do regularly. And a good way to do that is to walk backwards, actually. And apparently, like, Asian cultures have been doing this for centuries. They realized, whether it was scientifically or not, it was just correlated with a lower rate of arthritis in your knees, right? And learning more about this, there was a study done where they were studying all these people and their strength of their knees and stuff. And there was this one subgroup that had amazing knees. And it turns out they were Finnish, and they were Finnish loggers. And I know this appeals to you, Axel, because your wife is Finnish and you actually own some timber land over there. So yeah, these guys would cut down the tree, and then they would have to drag the tree back to camp. So they were doing these like really heavy weighted pulls with the logs that they were cutting down. So my guy has me doing a ton of weighted sled pulls where I take like 300 pounds and I have to just drag it across, asphalt.
My 82-year-old father-in-law recently saw him cut down 20 trees and did just that, right? I mean,
really? So his knees must be great.
He is doing great. But since we're talking about health advice, since we're the experts on every topic, so one of the things I changed in running, every few years I have an injury, and then I think of things. So there's this one guy who says that 80% of people get injuries in running and 80% of people run wrong. And so he promotes what he calls the POSE method, POSE. And I embrace that, and it's I haven't had any injuries since, and it's so I'm experimenting with those sort of things once in a while. But yes, ranch work is fun. You do get poison oak exposure and other things that aren't so much fun there, but it's all part of the deal.
That is the one thing I'm allergic to, and I grew up in New England, so we get poison ivy a lot, which is bad. But the poison oak out here in Northern California it's industrial strength.
So fun factor. We had a fire, I think it was in 2020. And we had the fire department, they dropped a bunch of fire hoses in the area. And so last weekend, actually, I thought hopefully the last one in the flail mower, that's the lawnmower attachment, where I was kind of doing some fire prevention. And getting that off the flail mower is very difficult. And they were in ash, and the kind of the oil of poison oak survives in the ash, and so as I was getting it off, the dust was getting to me, and so here on my chest I got some poison oak exposure. Not much, but it gets you in many different ways. So there's always a surprise somewhere, but it's all worth it because it gets you away from the desk.
You're a good man. I would have trouble keeping that perspective. Folks, we'll wrap up here, but my last point on this is one of the last times I got poison oak out here, I burned it unknowingly, and so breathed it in, and so got a systemic reaction. It was just awful. So anyways, I'm glad you're feeling better, my friend. Keep with the ranch fit. Folks, if you're a runner, look into the pose method that Axel recommends. And if you've got any knee issues, definitely think about doing backwards walking, ideally backwards walking, pulling a weight. And I can recommend, there's a guy on YouTube called Knees Over Toes Guy. That's a good free resource to look about knee rehabilitation. Axel, my friend, thanks so much. Looks like folks want us to continue these, so I'll see you back at the end of July. Until then, have a great time. Thank you so much again for doing this, my friend.
Yep, my pleasure. It's been great.
Oh, real quick, before we go, I got to ask you this. So if folks want to follow you and your work, Axel, where should they go?
Here we go. At Axel Merk on Twitter. I can't talk about products there, but you can get my economic views. Otherwise, merkinvestments.com is our corporate website. I can't talk about our products here, but you can learn more about them as you click your way through there. There's a newsletter you can sign up there. That's free. And otherwise, back on your program, where we just might talk about exciting things again, investment advice on running and the like.
Look, we cover all topics here. And folks, if you want to get some help in terms of figuring out how to navigate this market, as always, you can fill out the short form right there at thoughtfulmoney.com and schedule a free consultation with one of the financial advisory firms we endorse. All right, with that being said, Axel, thank you, my friend. Really appreciate you coming on to do these for us. I think you're going to be stuck with us as our ride or die for these for as long as at least the Fed keeps doing these conferences. Maybe they'll take your advice and they'll do a lot less going forward. But until they do, we'll be seeing you here regularly.
Take care.
All right. All right. And then everybody else, thanks so much for watching.